Last episode, we talked about locating deals, where to find investment opportunities that can build time freedom, financial freedom, and stress freedom. But finding a deal is just the beginning. The question is, how do you know if it's actually worth your money? Today, we're covering phase two, investigating a deal. I'm going to show you how to conduct due diligence the same way we work cases, methodically, skeptically, and with an eye toward what can go wrong. Because in investing, just like in law enforcement, assumptions get you hurt. Evidence protects you. Before we dive into the investigation framework, let me remind you why this approach works. I'm Ramel Lee. I spent more than 22 years with the New York State Metropolitan Transportation Authority, bridges and tunnels, rising from officer to deputy chief. I served in multiple commands, acted as incident commander for nationally significant events, and led complex multi-agency operations. Every day in that role, I had to assess risk, evaluate intelligence, and make decisions where people's lives were on the line. I couldn't afford to guess, I couldn't afford to be careless, and I couldn't afford to ignore red flags. That same discipline carried over into my investing career. Over the past 20 plus years, as an entrepreneur and investor, I've evaluated hundreds of investment opportunities. I've built 3 7-figure companies. I founded RD Lee Capital Partners, which at its height managed approximately $20 million in assets under management. And here's what I learned. The deals I passed on because something didn't check out saved me more money than the deals I made. Due diligence isn't just about finding good investments, it's about avoiding bad ones. My approach to investing is rooted in the same principles that guided me in public safety. Prepare for what can go wrong, not just what looks good on paper. Downside protection, realistic underwriting, long-term sustainability over speculation. I also founded the Unlimited Pension Collective, a growing community of law enforcement professionals committed to financial education and ownership. Our mission is to help officers reduce reliance on overtime, supplement pension income, and reclaim control over their time and financial future. Today, I'm going to teach you how to investigate deals using the same mindset that kept me safe on the job and protected my capital as an investor. Quick reminder, every successful investment goes through 3 critical phases. Phase 1, locating a deal, finding opportunities. Phase 2, investigating a deal, due diligence and analysis. Phase 3, closing a deal, execution and ownership. Last week, you learned where to hunt. This week, you're learning how to verify. Next week, we'll talk about execution. Think of it like police work. You identify a suspect, you investigate the case, and then you make the arrest. You don't skip the investigation phase, and you can't skip it in investing either. Here's the truth. Most officers who lose money in investments don't lose it because they chose the wrong asset class. They lose it because they didn't do the work. They got excited about a deal. Someone sold them on the vision. The numbers looked good on paper, and they wrote the check without asking the hard questions. That's not investing. That's hoping. And hope is not a strategy. The officers who build real wealth, the ones who achieve time freedom, financial freedom, and stress freedom, are the ones who investigate before they invest. They ask uncomfortable questions. They verify claims. They look for red flags. They protect the downside first. Today, I'm giving you the framework to do exactly that. When I evaluate any investment opportunity, I use what I call the RDL investigation framework. This is the same checklist I've used to protect my capital for over 2 decades. RDL stands for R, returns, D, downside, L, liquidity. Let's break down each one. First question, what are the realistic returns and how are they generated? Don't just look at the headline number. Dig deeper. Questions to ask. What's the projected cash flow? Is it monthly, quarterly, or annual? What's the total return over the investment period? Cash flow plus equity appreciation. What assumptions are those returns based on? Occupancy rates, rent growth, exit multiples. Are the projections conservative, aggressive, or realistic? What's the track record of similar investments or this operator? Here's what I do. I stress test the numbers. If the deal assumes 95% occupancy, what happens at 80%? If it assumes 3% rent growth, what happens at 1%? If the exit cap rate is 5%, what happens at 6.5%? If the deal only works under perfect conditions, it's not a good deal. It's a gamble. Real example, I once looked at a hotel deal that projected 18% average annual returns. Looked great, but when I dug into the assumptions, they were banking on aggressive ADR increases in a shrinking market and a best case scenario exit cap rate. I passed. 2 years later, the deal underperformed and investors got half their projected returns. Due diligence saved me from that loss. This is the most important part of the investigation, and it's the part most investors ignore. What's your downside protection? What happens if the investment fails? Questions to ask. What's the worst case scenario? How much can you lose? Is there collateral backing the investment? Your real assets, personal guarantees. What's the legal structure? LLC, LP, corporation? Who controls the decision making? Do you have any voting rights? What's the operator's skin in the game? Are they investing their own money? What happens in a downturn, recession, or market correction? I approach every investment the same way I approached incident command. Plan for the worst, hope for the best. If I can't afford to lose the money, I don't invest it. Period. Example, I invested in a hotel deal a few years ago. The operator had multiple successful exits, strong financials, and a proven track record. But most importantly, they had $2 million of their own capital in the deal alongside ours. That alignment of interest told me they weren't going to walk away if things got tough. That's downside protection. Always ask, what's keeping this person accountable? Bro, what's their incentive to protect my capital? Liquidity means, can you access your money if life changes? Some investments lock you in for 5, 7, or even 10 years. That's fine if you understand that going in. But if you might need that money for an emergency, a kid's college tuition, or an unexpected expense, you need to know your options. Questions to ask. What's the investment timeline? 3 years, 5 years, 10 years? Can you exit early? Is there a secondary market? Are there penalties for early withdrawal? How is liquidity determined? Quarterly redemptions, annual windows, sale of the asset. What happens if you need emergency access to capital? I've seen officers invest in deals that sounded great, but when they needed their money for a family emergency or medical expense, they couldn't get it. They were stuck. That's why I always keep a portion of my portfolio liquid and never invest money I might need in the next 12, 24 months. Example, I invested in a real estate syndication with a 5-year hold period. I knew going in that my capital was locked, but I also had other investments that were liquid, stocks, a HELOC, cash reserves. So if something happened, I wasn't scrambling. That's strategic liquidity planning. Those are your 3 pillars: returns, downside, liquidity. Every deal you evaluate should pass through this framework. If any one of these raises a red flag, you dig deeper or you walk away. Now let's talk about red flags, warning signs that should make you pump the brakes or walk away entirely. Red flag R1. Pressure to act fast. If someone tells you this deal is closing tomorrow or only a few spots left, that's a red flag. Legitimate operators give you time to do due diligence. Scammers create artificial urgency. Red flag number 2, unrealistic returns. If someone promises 30%, 40%, 50% annual returns with no risk, run. High returns come with a high risk, always. If it sounds too good to be true, it is. Red flag number 3, lack of transparency. If the operator won't share financial statements, won't answer your questions, or gets defensive when you ask for details, walk away. Transparency is non-negotiable. Red flag number 4, no track record. First-time operators aren't necessarily bad, but they're higher risk. If you're investing with someone who's never done a deal before, you better understand that risk going in. Red flag number 5, misaligned incentives. If the operator makes money, regardless of whether you make money, through fees, not performance, that's a problem. Look for deals where the operator's returns are tied to your returns. Trust your instincts. If something feels off, investigate further. And if you still don't feel right about it, pass. There will always be another deal. Here are some tools and resources you can use to conduct your investigation. For real estate, county property records, Free Public, Zillow, Redfin. For comparable sales and rental data, city planning and zoning departments for development restrictions. For businesses and operators, Better Business Bureau, BBB ratings, SEC filings for public companies or registered offerings LinkedIn to verify backgrounds and experience Google reviews and investor testimonials. For syndications, review the Private Placement Memorandum, PPM, carefully ask for investor references, talk to people who've invested before. Check the operator's track record, past deals, exits, investor returns. Don't be afraid to ask questions. Good operators expect it. Bad operators avoid it. Here's your homework this week. Take one of the 3 deals you found last week and run it through the RDL investigation framework. Identify at least 2 red flags or concerns you need to address before moving forward. Reach out to the operator or seller and ask clarifying questions. This is where you separate emotion from evidence. This is where you protect your capital. Remember, you're not trying to talk yourself into a deal. You're trying to talk yourself out of it. And if it still makes sense after investigation, then it's worth pursuing. Next episode, we're covering phase 3, closing a deal. How do you actually execute? What does the paperwork look like? How do you fund the investment? I'll walk you through the final steps to ownership. Thanks for tuning into the Bankroll Call. If this episode helped you understand how to protect your capital through proper due diligence, hit subscribe, comment, and share this with a fellow officer who needs to hear it. Because building wealth isn't about jumping at every opportunity. It's about making smart, informed decisions that create time freedom, financial freedom, and stress freedom. You can connect with the Unlimited Pension Collective and me. Let's investigate deals like detectives and invest like professionals together. I'm Ramel Lee, and I'll see you next week as we close deals and take ownership. Stay safe out there and stay sharp.